What's going on, guys? Welcome back to another video. In this one, we're going to be going over 4 key principles to really help you take your trading to the next level. So there's a couple of things that we really need to go over to make sure that everybody fully understands. Some of them are going to be easier to do than others and easier said than done, but these are things that you guys need to keep in mind every single day going into each and every trade that you are taking. So again, guys, if you do enjoy the information and analysis that I provide for you guys in these videos, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who do want to learn, because at the end of the day, we are all in this market to make money. If you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So let's just come over here really quickly. These are going to be the 4 things. The first, emotional intelligence and rules. Now, the rules that you're going to be implementing when you are trading are always going to come first. Now, if you are in our trading group, you guys know exactly what those rules are. We have a very, very specific set of kind of parameters for risk management, for entering and exiting trades, and you need to be able to understand exactly why those rules are in place, because at the end of the day, trading is a numbers game. It's just math. If you are able to win more than you lose, you will win. If you are even able to maybe win a little bit less than you, or win a little bit less than you lose, but your winners are able to ride a little bit more, and your actual risk to reward ratio is going to set you up for profitability, well, then you are going to win. It is just simple math. Why do you think that our new algorithm Pythagoras is able to have so much success? He has a very specific set of rules, and there is no human emotion tied to any of the decisions that it's making in the market. Now, again, Pythagoras is a predictive algorithm that is trading on the daily time frame. We also have Invictus, the predictive algorithm that is alerting on the 5-minute. If you guys do want to get access to those, again, all of the other private live streams, the learning curriculum, the charts, the other alerts, make sure you guys check out that link down below. It is the best place to come and learn how to trade, so make sure you check that out if you guys are interested. But when we're thinking about these rules here, we have to kind of treat them almost like the law. If you have your specific set of trading rules, there is nothing that should be able to kind of detract you or make you go away from those rules, because all of those rules, like we have just said, are in place for a very, very specific reason. Now, this second concept that I kind of want to bring up to you guys is slow it down. I think what happens a lot of the time is you see a lot of people either on social media, or most of the time it's probably going to be on social media, either flexing cars, gains, 1000% gains on some of the option trades that they're taking. And it almost makes you want to take more risk than you need to, or try to speed up the process to increase your account size, because I know a lot of you guys are probably trading with smaller accounts and you want to get up to those larger numbers. But what you have to think about is, well, if you are taking a very, very risky trade with a certain percentage of your portfolio, would you act the same way if your portfolio was 10 times or 100 times as big? What you need to do is essentially build that foundation of really, really solid skills now while you have a small account, because again, more money in your account is not just going to magically make you a better trader. If you are able to make money with a small account, slowly step up those gains, you are building that foundation in order to succeed further when your account size is larger. The other thing that I want to talk about with slowing it down here is you don't want to have too many trades open. You don't want to be trying to flip contracts in and out really quickly, enter a trade quick, enter this trade quick. You want to be able to take those high quality setups that you're looking for according to the rules that you have outlined for yourself, and really focus in on one thing. What went right? What went wrong? What could you have done better? Did something happen that you didn't see that maybe you think, okay, well, I should have been aware of this, and you learn going into the next trade? Slow it down. The power of compound interest is a beautiful thing. You do not need to be trying to aim for these multi 100% gains in order to set yourselves up in a solid spot for long-term growth. Because at the end of the day, if you're taking really, really risky bets in the market all of the time, well, then you can think of that as you don't necessarily want to be in the market as long. I think a lot of us want to be trading for a very, very extended period of time. And in order to be able to do that safely, you're going to need to slow things down and build that foundation. Now, kind of going off of this is going to be risk management. We did take or talk about some of those more risky positions that you could be taking and why a lot of people might be doing this. And that's going to be something that might be difficult for you to kind of get under your belt. Risk management and that emotional intelligence here is going to be a key aspect of becoming a profitable trader. And again, that's why our bots and algorithms are able to have so much success, because they don't have any emotions tied to them. But risk management is going to be another key concept as well, because you have to understand exactly how much you are willing to risk on any given trade. Now, what this also enables you to do is, again, slow it down. Because if you know that you are only risking a set percentage of your portfolio on any given trade, and you have your stop losses set, you are all ready to go, well, then the whole process is a lot easier. There's a lot less stress. And if you are stressed when you're taking a lot of these positions, odds are you're probably trading with money either you're not willing to lose in terms of the set stop loss that you've set. And again, maybe too much money than you're fully comfortable with trading with right now. Now, the last thing that we're going to talk about here is actually getting a little bit more time on your contracts. The reason for this is, again, kind of going back to that slowing it down. Time decay and theta, in my opinion, is the most important Greek that you need to understand, mainly because this is going to be something that's going to greatly affect your options premiums. If you're holding overnight or even on an intraday basis, because as you can see here, when there's more time to expiration as we zoom in, the effects of time decay or theta decay are going to be a lot less. You can see the slope of this graph right here is greatly accelerating as you get closer to expiration. So what this is telling you is that if you're trying to trade daily expirations or weekly expirations, yes, it's very possible that you are able to hit these big gains, but the effects of theta and time decay are going to be very, very, very significant. Now, again, when we kind of take a look at an example of this right here, what time decay also enables you to do is getting more time on your contracts, not time decay, but getting more time on your contracts actually allows you to capture the full move. Because when we're trading options, remember, there is a set expiration date out in the future that these contracts are going to expire, and you have to make a decision on what you are going to do before then. You're either going to cut your losses, exercise, or take profits. Now, let's say here that you wanted to enter in on this Apple trade, and let's say it's a Pythagoras trade too on the daily, where you would have been alerted way down here, and let's say you were only trading about 2 weeks out of time. So this date right here is July 12th. You're coming up here. Let's say this is going to get you to about, or let's say you're trading weeklies here, July 28th. The 12th to the 28th, it's about 2 weeks. It's about a week here. But when you're looking at this, the bulk of the move happens after. Now, again, you're going to see a lot of volatility coming into these moves. Since you have less time, your contracts are going to greatly appreciate. They're going to decrease. They're going to come back up. They're going to come back down. And that's going to be a more stressful position to hold than if you're trading 1 month out, 2 month out, 3 month out in time contracts. When you're looking at this chart here and you're following some of the rules that we're teaching you guys, especially with the rimming this 13 EMA all the way up, there was really no set in stone exit signal until recently when we fell down below this 13 EMA. So getting more time not only enables you to kind of lessen the volatility and the giant fluctuations that you're going to be seeing on these option trades, but it also enables you to capture the full bulk of the move. So guys, that's going to wrap up this video here on some couple of trading tips that are going to help you guys become more profitable and really take control and empower yourselves to make money in this market. If you guys did enjoy the information and analysis that I provided for you guys in this video, make sure you go down and hit that like button. It costs you nothing to do it. And other than that, guys, I'll see you in the next one. Peace.